Welcome to the PI World interview, April 2021. And today I'm delighted to be joined by Andy Brough, head of the UK and European small and mid-cap team at Schroders. Andy, thanks so much for joining us.
Yeah, it's good to be back.
So last week you commented on our Stockopedia PI World StockSlam on Twitter saying, "What I like about this as a fund manager is that it throws up companies I'd forgotten about or not even looked at. Great presentations." So what can fund managers learn from retail investors?
I think if you think about it, there are only a certain number of hours in the day to look at companies. I might have sort of 230 positions across my funds. Some of them are reporting, some of them are having disasters, some of them are doing deals. So the time for finding new ideas can be quite small. And so actually having a community out there, and it kind of reminds me of Dewey Finn from School of Rock, when he's got the kids and he's teaching them his song. And then Zach, the lead guitarist, has written his own song and he grabs it and says, "Well, let's play this." And Zach goes, "What? No, this is what bands do. They play each other's songs and they learn together." And, there's a lot to be said from it. I'm not basing my whole investment thesis off School of Rock, obviously, but there's a lot to be said for having these sort of ideas that are out there, which you can kind of go, "Oh, that's quite interesting." So on that particular one, John Menzies, I kind of looked at it and thought, I've got a small holding. I should go back and have a look at that. And I've been in dialogue with Cockney Rebel, Tandem is quite interesting, but probably a bit small. And Micro Focus, I've actually started a new position, gone back in. This is a stock that got into the FTSE 100 at 19 quid. And here we are back in mid-cap land at £5.40. And also, not just that, but also that whole sort of Twitter community, which kind of grow out of it. Another one we bought, DX, which people were sort of raving about, got the guy in, went through it all and bid the largest holder for 20 million shares. And here we are with, top 10 position on their sort of shareholder register. So one thing I've learned in my career is you just got to go out and never dismiss anything that people are saying. And if people say, some areas like, mining stocks or whatever, I just haven't got the bandwidth for. But it suddenly just goes, "Oh yeah, I forgot about that company. Oh yeah, I've made a lot of money out of Wincanton and I watched Clipper Logistics go up without us." And actually DX, that might be an interesting thing to get in and just talk about the industry, because you always learn something.
Aren't they a bit small? Isn't it difficult with a fund of your size to get a decent position?
Well, that's an interesting question, isn't it? People go, "Couldn't buy them," no liquidity. So people say, "Well, how did you amass that position in Xaar, 28%? How'd you get that?" I said, "Well, I'm going to let you into a little secret here, right? There were the same number of shares in issue at 30p as there are at £1.40. You are confusing the market size with liquidity. I don't mind hoovering up vast amounts of shares at a low price if I think they're woefully undervalued." And people go, "Well, it was only 0.3 of your funds." And you go, "Well, it was, but now it's like 1.2, and it's done its job, isn't it?" And so, I'm not averse to having these big positions in terms of market cap percentages, and not worrying too much that it's just a small portion of the funds, and then you can grow with them. Everyone goes, "Oh, I'll wait to £1.40. I can't buy them now."
So if that's what you learn from the retail investor, what do you think the retail investor can learn from the institutional investor, the fund manager?
Probably patience. And just looking at companies in, just making sure that what you're buying, if you think about it, if you had a company yourself, then you want 100% of the equity, so that any earnings or increase in earnings or assets came to you. Because I look at really successful businesses like, look at JD Sports. When the Pentland Group bought them, the first thing they did was cancel all the share options. So if you want some shares, you go and buy them yourself. Manview Estates, which I own personally, is too liquid for the fund. I actually, before this, I thought, I wonder how many shares they had in issue in 1980. And he goes onto Companies House. And actually, they had more shares in issue then than they do now. They've shrunk the equity base by 30%. And the shares have gone from £2 to 112. Yeah. So always it's golden rule number one, keep an eye on the share count. Yeah, because at the end of the day, the earnings and the assets have to be spread over all those shares. So when the Hut Group magnanimously give 20% of their equity to the guy for achieving some spurious share price target, then hold on, you've got to generate 20% more earnings just to get back to where you are. You know, everyone's piling into these travel and leisure stocks, grand reopenings. Well, hold on, they've all increased their equity bases by between 25 and 50%. How are they ever going to get back to peak earnings when their share prices have got back to where they were? And so that's what you can learn. Don't get just sucked in by the share price movements. Just look at some of the basic things and just think about, if it was your company and you owned it, what you would do. You take Fraser's, Mike Ashley, when he floated, sold 300 million shares at £3. And since then, he's bought back 120 million of those shares, because he recognises that if he's got 65%, you might as well have less shares in issue. And you look at people really, smart investors like Katie Potts at Herald Investment Management, good mate of mine. All she ever does is buy back her own shares. And she issued the shares at £1 and she's buying them back at £21 because she still thinks that, actually, I don't want all those shares trying to generate a return. I'd rather have less shares in issue.
Yeah, interesting. So if you had 3 minutes to pitch a stock, what do you think you need to cover?
I think in 3 minutes, I think what you need to do is you need to kind of just think about what are the inputs that go into that business, and then what the company does to them in terms of process, and then what the outputs are, i.e. how they actually sell the product. So keeping it relatively simple and just thinking about a few macro things that may or may not impact that, and then just thinking about what the road journey is for that potential stock. I look at things I've sold far too early. ASOS, did well, 50p to £3.50, whatever, and here we are. Because I made the fatal error of saying, well, relative to Findel as it was then, ASOS looks ridiculously expensive, even though the business model had changed. Someone said to me, it's very easy to look forward a year, but very few people can look forward 10 years. And if you can look forward 10 years then, and hats off to those guys and girls at Bailey Gifford. Hats off to them. They've been absolutely brilliant. And because they've been able to do that, look forward 10 years, what could this thing be like? And then say, well, actually, what are the risks of them sort of getting there? And then just looking at the numbers and saying, right, are those numbers real? Are you capitalizing more and more software each year just to make the numbers, stretching the creditors, factoring the debtors, all the sort of basic things? And it's a combination of those two, which more and more, I think, is the way forward. But it's time to think, what could it be in 10 years' time? I remember someone saying to me when Tesla were $18, I said, look, mate, it's never going to work, really, is it? And here we are at $650.
You've always been quite good at selling, and you've always been good at saying trees don't grow to the sky. So how do you determine between those that aren't going to grow to the sky and those that will just keep on growing?
It's quite interesting, actually. I've got a big client, and I had an hour's call with them for an update. I've had them for about 20 odd years, and they analyse every trade I do. They analyse every trade I do, when I buy them and when I sell them. And quite complimentary, they said to me, Andy, look, you buy them when they've gone down and you sell them when they've gone up. I said, well, after 30 years, it's good to know the secret of investment, isn't it? Buy low, sell high. And he said, look, just trade more. Can you just trade more? I said, well, you've got to wait for them to come along. I mean, sell signals, it's interesting listening to my old partner in crime, Rosemary, who'd obviously stolen a lot of my ideas. But that's teamwork for you. Is that, no one tells you when to sell a share. This whole industry is geared up. Buy this share, buy this one because relative to something in South Korea, it's really cheap. Buy this one because it's been left behind. So we kind of, over time, came up with a sell signal that, looking at the margins, are those margins sustainable? When Capital Radio in the old days got to 45% margins, well, all that advertising from the internet boom wasn't sustainable. You sell the shares. Too many acquisitions. I'm a big fan of that. We spoke earlier about one. What does it contribute? How much did it contribute in that period? And then you've got to go and make another one. And actually, getting into the FTSE 250 or getting into the FTSE 100, that's probably as good as it gets on the trees don't grow to the sky approach. But there's no one thing that does it. For me, if I'm starting to wake up early worrying about a share, then that's normally a good time to go and get the file out. And we will actually trade positions, quite happily, act as market makers. So, in example of Dark Group, when I first met Castleford Tiger online, and he said, they're worth X. And we went from virtually nothing to 22% of the company. And now we're out. And we've traded that all the way up. They've gone up, we've sold a few, they've fallen back down, we've, bought them back. And so we're prepared to do that. Even with a large fund, we recognise that you'll get periods of exuberance in the market, which you've got to sell a few, and you get periods of despair where you can then buy them back.
So for the ones that you sold too early, what do you think you got wrong there?
Well, I'll give you the example and the lesson I learned from it. So, ITM, I dragged Ian along, who works with me. He's got a PhD in quantum physics, and I've got a C at O-level physics. So we are the perfect team on the basis that if I understand it, then that's dangerous, right? So ITM, 20p, 30p, refinance it, gets to 80p, look at the market cap, sell them, and it goes to, I don't know where it got to, 6-7 quid. I'm going, this is ridiculous. The market's always irrational. You just hope it's irrational in your favour. So as an investor, you have to take the lessons from that, and we put that into AFC. And we've kept, about a few years ago, I called John Rennox, who made us a lot of money out of Nestor, which we sold to Saga at a crazy price. And I said, John, look, in my memory, you were always interested in fuel cells. Would you do me a favour? I've got a small position in AFC. Would you go and have a look at it for me and tell me it's a basket case or not? And he came back, he goes, actually, they might have something here. I'll become chairman. So I said, right, you've got carte blanche. Right, off you go. I've kept it alive. And he's just stepped down as chairman. He sent me a really nice email saying, Andy, without Schroders and the team, then this thing would never be where we are today. Got a great opportunity. If you told me 4 years ago that the share price would be 10 times higher on, a massively increased number of shares, I would have asked what you're smoking. So, but we've learned from the mistakes of ITM selling too early. In AFC, we got in early, we sold out some, we bought them back, we financed them. But that's what we do, Coming back to this point of information, I always keep an eye on what people are saying on the bulletin boards for some of these shares. And when we first bought 10% of AFC, the people on the LSE board went, oh my God, thank Schroders with all their incredible analytical power have bought AFC, they must think it's going to work. I didn't have the heart to tell them that it was me with my C at O-level physics. Anyway.
So going back to what you need to include in a 3-minute stock pitch, do you fancy doing a 3-minute stock pitch now?
Yeah, actually, I knew you were going to ask me that. And I thought to myself, should I worry about, and go through what we've got in the fund or something? And I thought, you know what? I'm going to come in today and I'm just going to read the results and hope there's something in there that actually I can do a 3-minute pitch on, which I believe in, and I do actually hold it. But so I came in this morning, turned on the screen, Studio Retail, which ironically is the old Findel, which is talking about ASOS. And it started life as a sort of catalogue retailer, a bit like M Brown.
Sorry, has your 3 minutes now started?
This is the warm-up.
Oh.
Is there a bell or whatever? I mean, I'm dealing with amateurs here. What's going on?
We can start the timer when you're ready.
Yeah, start the time when you're ready. So Findale lost its way. Myself and Tosca had 60% between us. Mike Ashley phoned me up one day and said, will we sell him 10% each? And we went, yeah, all right. So we sold him 10% each, and he got himself into a position. We had a strategic review with the business. And this company, like so many of some of these old economy stocks, has suddenly gone, hold on a minute, catalogues have gone. We've got to get into a new form of marketing here. We've got to get online. So 100% of sales now online. And they came out today and said, bid talks are off, no strategic buyer. We've sold our education business, so we've got cash in the bank. And by the way, last year we made 23 million, 27 million, and this year we're going to make 50. And interestingly enough, that what you're seeing is after the first 6 months, there was 6 million ahead. After 9 months, there was 16 ahead. And there were, after the full year, sort of 22. And it reminds me a bit of Tremor, where you get that sort of momentum in the business where you're making more and more money sort of each quarter once you sort of, and then you suddenly look at it and you go, well, how many customers have you got? Well, 4 years ago, they might have had 1.5 million customers. Now they've got 2.5 million customers, of which 1 million use their app, or 1.5 million use their app. And so suddenly you've got a growing customer base, and you've got people who are now used to buying and not sort of going to the stores. And you've got a population which perhaps is in the B&M camp in terms of social groupings. And you just see what's happened to B&M. And then you look at the credit offering. Last set of results, they still were last year, we better provide 20 million quid for COVID-19. Haven't needed to touch that, no furloughing. And so we get a position here where they've come out and said, look, our immediate term object is to get to 1 billion of sales. We're talking about having a runway, looking at what the path is. 1 billion of sales. They're probably doing about 570, 560, 570 now. So what's that translate into? Well, 1 billion of sales would translate into 90p of earnings. Now, I don't know when they're going to get there. They've got a capital markets day coming up in July. I don't know what Mike Ashley's going to do. I sent him a text earlier today, but I think he's in America. And you look at it and you think, well, actually, the reason we called a strategic review, because we were kind of stuck. We've got 21, he's got 36. I don't know what's going to happen, but you look at what happened with JD Sports when they suddenly became revitalised. So there could be a huge stock overhang, don't get me wrong, but I look at this business now, if you can get to 1 billion of sales and you can get to 90p of earnings, at £3, it's worth a look. One of those old economy stocks, which we've spoken to in the past about car retailers, which are on fire, and these stocks which have reinvented themselves for the brand new world of social media.
And just one question for you. If you had to guess how long they'll take to get to that earnings figure, how long do you think that would be?
Well, I would think the pace they're growing, they could potentially get to 1 billion of sales within 3 or 4 years.
Very nice. That was very good, Andy. Very good indeed.
Off the cuff as well. There you go. But I could have had a shocker, couldn't I? I could have been talking about a stock I don't own. It's had a terrible time and I'm trying to dress it up. So, sometimes you get lucky.
You're a natural. So how important is the retail investor to listed companies?
Well, I've sort of made, I grew up in the era where people were queuing around the block to get their tie rack and sock shop applications in. Members of the family were filling out applications in the name of DDUC and MMAS for all the sort of government privatisations. And the private investor were very much forefront of those sort of things. And I always thought it was a good way of keeping the broking community honest, because you can see now it's not so much that Deliveroo is 30% below the float price. It's the 50 million quid that Deliveroo customers have bought that has got a lot of the attention, and that big banks are terrible, et cetera, et cetera. And so I think having the resale punter in there keeps them honest.
Interesting.
And I think if you look at the pool of savings that has been built up in this country, and for right or wrong, during this period, everyone's become a stock market expert. Right? So my eldest lad, well, Max, 27, he says, Dad, I think I should be doing my own thing now. I went, Max, it's a compliance nightmare. I said, if you do it, you must not tell me what you're doing. I must not know, because I'm not going to tell you what to buy or sell. It's got to be completely arm's length. I've got your ISA and your dealing account. I can do that, with getting the various permissions, but I cannot do anything if you're on your own. So, about 2 weeks later, I kind of drop something off at his house. He opens the door. I go, Max, you're all right. He goes, brutal day in the market. Brutal day. And I think, what? Honestly, I was going to say to the wife, oh my God, he's on his own. He's on his own. Now he's, $2.5 grand up. Oh, Dad, I think I'm really good at this. But that's what the retail punters done. They suddenly realised that actually there's a whole world out there of a way to make money. So, he's presumably looked at companies. He had a crash course from me, and but just looking at things, what to look at, and just thinking through, and just thinking, well, actually, Max, where are you spending your money, your industry you're in, who's doing well, who's doing badly, and then they suddenly become interested, and the other two go, no, you're too young, I say. But the other two are suddenly thinking, well, maybe I should have a go at this. This is the way forward, taking my earnings and not putting them in the bank, but trying to get involved in businesses and then really understanding what the power of equity is. And I think it's good, actually. And I think, I do, before the pandemic, I used to do a lot of speakers for schools for Robert Peston. So I might go and speak at 4 or 5 state schools a year, and just getting people sort of tuned in with thinking about equity. And the thing that's really surprised me about Twitter is, first of all, A, I've managed to get to 414 followers, but B, is the sort of conversations I've had. I mean, I've had people approach me directly and say, look, I'm 37 or 36, 37, I'll turn 10 grand into $1 million. Could I get into fund management? And what I've done is I've actually had Teams calls with these people. So I will say, if people contact me directly, then I'll have to have a Teams call for like 20 minutes, because I want to know how you've made that money, how you're thinking.
Have you employed any of them?
I haven't employed. Well, I'm not. Schroders have got enough mavericks. They've got one, so I'm not sure they could cope with doubling that. Anyway, but things like other places, which when things quiet down, say, look, do you want to have a chat with these people, or it's just talking to them and saying it's just quite interesting, and saying, look, you've probably got a good job at the moment. We have had a bit of a bull market. Let's not confuse our own brilliance with the bull market here. And you've done incredibly well. And I like the way your thought process works and how you look at companies, etc. And thanks for contacting me. And the fact you contacted me means I'll contact you. And it's the same with kids. I did a thing for the London School of Economics, which had a female-only sort of session. And they asked me to go and speak to them. And I said to them, 10 of them, I said, look, if any of you want to pop in for a cup of tea to talk about stocks and shares or your careers, then just drop me a line on LinkedIn and we'll sort that out. Only one of them bothered.
Interesting.
I thought to myself, you know what, I wouldn't employ the other 9. I did say to them at the start, I said, listen, when I started, I didn't know this job existed, but they pay you decent money to gamble with other people's money, right? And that is why it's so popular. But you must not go into this job unless you absolutely love it, because the market will find you out if you try and become too academic.
And what advice would you give to your younger self of, when you first started in the industry over 30 years ago?
I think what I would have said was, don't be scared by old, cynical people. I remember running money for Arcadia and asking Philip Green about ASOS. Nah, that's it. Tosh. Went on. He must know. So never assume that the old people know. Right? Computer games, I've been absolutely atrocious on computer games. Why? Because I was there with IDOS. Yeah. And so, take bits of their wisdom, if they've got any left, But think about your 10-year version. They're old. Their time horizon might be, I'm 60. Someone who worked for 5 years, I might go and find something that might work sooner. But it's having that ability to look forward and just don't get deflected by all the people going, yeah, never worked in my time. Because there's always new industries coming up. And, someone on Twitter, I think the market had a bad weekend, and people were saying, oh my God, have you checked your P&L? Oh, it's terrible, And I said something like, now I've discovered this medium about 15 years after it launched. Anyway, I said, look, I've survived this long, 129 quarters, by not looking when I've had a bad time, because the job is hard enough. And so you've got to maintain confidence at all times. Otherwise, you start dithering around. Should I buy that? Should I sell this? You've got to stay high enough up the risk curve. And that's one thing, if I say to kids, you've got to stay high enough up the risk curve, because otherwise you'll get old people going, oh, it never worked. So my middle kid, he's in the festival business. He came up with this idea for something he's going to do in the parks or whatever. Now, half of me was going to go, I went, yeah, just do it. So that's if I look back, I've had a good career, don't get me wrong, but that's what I would say, just do it.
Very just good.
Do it. It's like working with Gene. Gene would go, and I'll think, would I buy that? I probably wouldn't, but I'm not necessarily right. Just do it. And when you're running a team, you've got to maintain that sort of confidence that you've got to instill in people, and then the ability to, when things go wrong, to say, you know what, it hasn't quite worked out, has it? So let's withdraw as a team. And then the other person goes, I wasn't totally to blame. So Dunelm, which we bought, shares went down. I said, right, let's go and see him. So Gene and I went off to Bush House. We met their sort of digital team. I said, this is fantastic. £6, £5. Let's buy as many as we can. Now it's the largest holding in the fund. Gene feels absolutely, and that's increased her confidence. And so it's a balance between, telling people, imparting knowledge, but in a way it doesn't put them off. So I remember when she joined, she said, oh, JD Witherspoon's, sell it. I said, well, look, there's a meeting coming up with Tim Martin. I can get you in if you want. Why don't you go and see him? And she comes back and she goes, that's really good, isn't it? But, I could have told her that. But it's having that confidence. So the other thing I would say is, just talk to as many people as you can. As a kid, I try and encourage my children is just talk to everyone, because someone out there has got an idea, and you can take a bit of what they've learned in a different industry and apply it to yourself. And there's a whole world out there, and it's, I think the most frustrating thing I find is people just they get stuck in their silos, and you've got to get them out of that.
Now, coming back to the retail investor and listed companies, historically, IR has been very much geared to the analysts and the institutions, and very little with retail. How do you feel about that? Do you think companies should be doing more to communicate with retail?
Yeah, I do. And I think management should be made aware how important the sort of retail punter is to their shareholding. And actually the knowledge base of some of these people means that they're not going to be asking stupid questions. That's the thing. I think that's the problem, is that people think, retail investors, they won't know anything. Well, actually, you know what? Some of the things I see on social media, retail investors know as much as the fund managers.
And do you think personally for you, it gives you an edge to be able to meet management and ask them questions?
So I was very lucky, actually, to meet Jim Slater, because I remember reading his book when I was about 15, and I think that's really kind of sparked my interest in stocks and shares. And I went to lunch with him, and there's in a bit of awe. I said, Mr. Slater, you must go and visit loads of companies and meet loads of management. And he went, no. I said, what? But you never go on company visits? He said, no. I said, why is that then? He said, well, you walk into the office and you meet the chief exec and it all sounds very impressive. And the chief exec takes you on a little tour of the factory, and he walks up to the first operative and says, "Dave, how's it going? I hear your wife's had a baby. If you need any time off, we're this sort of firm." And you think, "Well, that's pretty good, isn't it? Caring, sharing." Of course, he's not called Dave. He's too scared to say anything to the boss, right? And so your impression of your hour up to Doncaster or 2 hours to Doncaster and back, it's an amazing company, when actually it's not. And so, you can meet management. And ironically, I've really got to like Zoom calls, because I've kind of, when companies come into Schroders, they're sent to the special lift and then they're deposited into the meeting room. And we spend the first 10 minutes talking about, are you going to have peppermint, Earl Grey, breakfast tea, coffee, fizzy, sparkling water or still, and looking out the window and people going, "Oh, your views are amazing, aren't they?" Anyway, so we settle down then and we have like 30 minutes. And then we talk about football and what people are going to do at the weekend. Well, you can do that on a Zoom call. You don't probably get the sort of body language, but you can still tell whether the chief exec's talking over the FD and answering all the questions, etc. So I think meeting management is important, but you can find out just as much of what's going on from looking at the numbers, looking at the industry, and just following the sort of trends. One thing Gene does really well is on social media, just look at how many people are looking at Ted Baker and say Superdry sites and just keeping a track on that. We had a chat with Ted Baker today, and the most interesting thing to come out of that was the fact that they are the first brand to go to a chat room. Do you call it a chat room? Yeah, which you have to be invited, and you think, well, actually, they used to be ahead of their time there. They used to be really quirky. Ray Kelvin used to be just crazy man. His mum used to work at the Harrods branch of the franchise of Ted, and she had a big badge on saying, "I'm Ted's mum," right? But they used to do quirky things like that, and you think, well, actually, maybe the culture of the company's back. So there's little things like that you pick up from meetings, which you probably miss out in the retail punter, which you wouldn't get. But even if you had a question and answer session, you probably wouldn't get that either. So, and it might mean nothing. It might be something, let's see.
Interesting. And what's your view on placings? We've had a plethora of placings. Do you think that's going to continue, or do you think we're getting to the end of it now?
I don't know where all the money comes from. Maybe the Bank of England is secretly providing funds to the equity market. We're going to find out in years to come, and it make the Greensill scandal look like a walk in the park. Anyway, I think there's been 54 new issues this year. Is it 20 that are below the price? Which in the euphoria, you think they'd all be sailing away, wouldn't you? So on placings, what we've looked at is that a lot of these companies, particularly in travel and leisure, have come around for the second time to fund their losses. And it comes back to the number of shares in issue. So if you're SSP, you've had an increase of 50% of your shares in issue. Yeah, that's a hell of a headwind to get your earnings going again. And people go, "Yeah, don't worry, it's all about recovery." And you go, "Well, is it? How are you going to get the staff? You've got to pay them a load more." I mean, where I play golf, they're already advertising now. We need more bar staff. And you just think, well, that's a little club in North London. If you're running a restaurant and all these things, your costs are going to be going up, etc., etc. So we haven't done many of these placings. I think a lot of people have got carried away in the euphoria, and I think it's going to be, people have forgotten that the most expensive thing you can ever issue is a share.
And what do you think of markets at the moment? Do you think that they're overheated? Do you think that are you an inflationist or a deflationist? Where do you think that we're heading?
Can I take Rosemary's line and say, I never look at the macro? Can I do that? Is that all right?
No.
So what I do, so it's quite interesting, right? So first of all, if you look at the level of margin debt in the States, then that's up $400 billion over a year to nearly $800 billion. And you wonder why all those firms like IG and all that lot are trading so well. a lot of it's on margin. And that has got to be a sort of cause of concern. Personally, I do look at PE ratios rather than on return on equity, because to me, it gives you some idea of how many years growth I'm paying for in that particular share at that time. And then I want to make sure that the earnings number is something that I can recognise, and actually the bank manager will recognise if you wrote a cheque to pay it into your account. So you look at it, I think there's a lot of these high PE stocks that are very vulnerable at the moment. It's quite interesting. If you go away and read the Hut's earnings, not that I'm bitter and twisted because I haven't got any Hut, but it's you look at it and you go, so hold on a minute, you made a big song and dance about saving 2.6, taking above the line 2.6 million in furlough costs. Congratulations. Oh right, okay. COVID costs of 39.9 million you've taken below the line. And what's going to kill this market in the end is actually the quality of accounting for a lot of these companies is going to, and the combination of the increasing number of shares in issue to spread that over, is going to come home to roost.
Interesting. And what's your view on inflation?
Well, fortunately, the inflation statistics are calculated excluding anything that's gone up in price. So, hold on, how does that work? I was in the banana run this morning, right, for me and the dealers, and you can get like 2 huge bunches of bananas, £1.88 in the Tesco's, which is fine. You think actually there's no inflation here, but I know when I go into the restaurants this week and next, there's going to be big inflation. And talking to my kids who've been on a bender since the 12th of April. They go, oh my God, Dad, the price of these things now, we spent 100 quid each. That's it, yeah. And it's just like crazy prices in these bars, because actually, they're kind of trying to make their money back. But I think there's a lot of pockets of inflation sort of coming, and it's going to be interesting to keep an eye. What I keep an eye on? I keep an eye on average wages, really, because if my thesis is right, then that's the first sign that you're going to see coming through. And Rosemary made a very good point. I mean, she made lots of good points in her article, but I particularly like the one about those companies with the fast asset turns, which enables you to recoup the price increases. And so distributors could be in a good place, actually.
And so other than distributors, how do you think we should position for inflation?
Well, inflation, when I joined traders, someone said to me, equities are a great hedge against inflation. So I've always tried to invest in companies that can put their prices up faster than inflation. Fortunately, for most of my career, that hasn't been a problem, actually. So I'm going to have to get the old textbook out and have a look. But that's what we're looking for. And you can see, little pockets, anecdotally, lead times on delivery for sofas. I was talking to DFS the other day. What's happening in sort of with builders, even the builder I use, who's very good actually. Oh my God, and I've never been so busy. House prices, you can see it all there, and people are going, yeah, but the Bank of England won't do anything. And last time, inflation got to 5%, and the Bank of England did nothing. I think if it got above 5%, let's say it gets to 6 or 7, then we could see that could get quite ugly.
Interesting. Andy, thank you very, very much indeed for your time.
I very enjoyed it.
And to find other interviews with Andy Brough and many other esteemed investors, go to piworld.co.uk. Many thanks for joining, and stay well.